All right, Jeff, you didn't slip me any notes, so what should I say? No, first of all, again, I'm extremely happy that we have keynotes that are traveling from Puerto Rico, from the US, to come and present here. It's a massive effort. I've done that trip so many times. Jet lag is painful. I'm not sure how you're feeling, Jeff, but I got back Saturday and I still have trouble getting up in the morning. So it's not a pleasure, but what it is a pleasure is that you're here. So Jeff, thank you so much for coming. He is the Gold Advisor over on Twitter. You have your own website, you write a fantastic newsletter, you're selling your book outside called Pay Dirt, where you can get a really good understanding of the mining and junior space. And you were with Mike Maloney for over 7 years, I believe, about 7 years with Mike Maloney at goldsilver.com. And really excited that you're sharing your insights about the gold and precious metals markets with us today. So Jeff, thanks so much for coming on. Oh, and one more thing. Ion Energy, the company, won't be attending. I'm not sure if it's crossed out in the agenda or not. And we've decided that Jeff will present for 30 minutes, and then I'll grill him for 15. And we'll discuss a bit, like, what are his insights. I'll follow up a bit on what you're saying. And if you have questions for him, we have 15 minutes to discuss. So save those, and we'll have some fun with that. Awesome. Jeff, please join us.
Thank you.
Clicker thingy.
Okay, great. All right. Hi, everyone. I'm really excited to be here. This is my first Deutsche Goldmesse, so this is awesome. It's so great meeting so many of you. If I haven't met you, please feel free to introduce yourself. For those that maybe don't know me, my dad was actually a gold prospector many years ago. He's in mining heaven now, but he had some success. He didn't work with a company. He worked on his own with a group of people. I cut my teeth in the newsletter business with Doug Casey's firm way back in the day. Lobo Tigre was actually my boss at the time. He was my mentor, so I learned a lot from him. So then worked for multiple dealers, multiple newsletters, and finally wanted to go back out on my own again, so I did. I started thegoldadvisor.com, and then I told myself I am not going to write another paid newsletter. It's a lot of work. 12 months later, I launched a paid newsletter, so I don't know. So you might hear all that and think, oh, this guy's just another gold bug. Well, I am a temporary gold bug. And what I mean by that is I'm a gold bug now because I'm forced by the political system, the monetary system, et cetera, to be overweight gold at this point in history. At some point, gold will likely be way overvalued, and other things will be way undervalued, and I want to participate in the wealth transfer, and so therefore I will sell most of my mining stocks, if not most of my gold and silver, so I can participate in the wealth transfer and maybe buy a beachfront condo with all the profits that we make, right? That's the whole idea here. So our starting point, I'm going to talk solely about mining stocks, but our starting point, obviously, as mining investors is gold. And many people have discussed all these catalysts. We've had war, we've had record central bank buying, we have looming interest rate cuts. One bank analyst forecasted that 11 major central banks around the world will be lowering interest rates this year. So it's not just a US-centric thing. 11 major central banks lowering interest rate. That is incredibly bullish for gold if that happens. China's been hoarding. We could do a whole talk on that. Debt and deficits has been talked about many times. I think it all started on leap year day, February 29th, when gold spiked because the day before the Fed indicated they're probably going to be lowering interest rates sooner than expected. That kind of changed a little bit, but that's when it all started. All of a sudden, gold skyrocketed, and then all of a sudden you had some shorts that had to cover. That helped the momentum. You had a momentum chasers and all that. But when you try to think about what the catalyst will be for gold, it may not be what we all think, right? We have a strong dollar, and yet the gold price has doubled since 2019. The US dollar has risen dramatically. It's been very strong. They're usually inversely correlated, and yet the gold price has doubled. So if you said, well, I'm not going to buy gold until the dollar starts getting weaker, you would have missed out. We've had no recession. Gold usually rises. We show in recessions that gold usually rises during recessions. We've had no recession. record stock market price, and yet gold is rising. So how do you deal with this? Well, the Greek philosopher Pericles said, don't predict, just prepare. And you might think, well, Jeff, how in the world am I going to prepare if I don't know what's coming? Exactly. You don't know what's coming. So you need to own a meaningful amount of gold. And a meaningful amount in this current environment, research shows, is 20% of your holdings in gold. Not mining stocks, in gold itself. That's what research shows. So for me, it's that last phrase. It's exposure versus cash. You know, a lot of people say, well, Jeff, I'm not going to buy mining stocks until the stock market crashes. Well, a lot of things have happened positive for mining stocks. As bad as it's been, a lot of positive things have happened as well. So I want exposure to it, but my buffer is cash. So think of that as your potential strategy. What's your exposure versus what's your cash balance? So you have those two things going at the same time, and it allows you to have exposure to mining stocks. So we are venture capitalists, especially if you're in the junior sector. We are venture capitalists. That's what we do. That's what we are, whether you recognize that or not, okay? There's three themes I want to get across today. One, it's not too late, and I'm going to show that to you. The gains could be huge. I'm going to show many examples from history of that. And number three, how to handle this. And that is basically to expect volatility and sell-offs. Okay, so let's go through some things. It's not too late. First, you maybe have seen charts like this before, but this is the HEOI mining stock index and its relation to gold. This is going back all the way to the mid-90s to present. You can see that this mining stock index, relative to the price of gold, is near all-time lows. GDX is newer, and yet look where it's at. GDX, relative to the gold price, is near all-time lows. We've rarely seen the price to NAV, meaning the price to the net asset value of mining stocks, this low. This goes back, again, to the mid-'80s, and yet the price to NAV ratio of these stocks right now, this is as of the end of last month, again, is near all-time lows. We're at the very beginning of another bull market. This shows the previous bull markets. The yellow is the current bull market. I do believe this is another bull market. I agree with Kai. The bottom is in for junior stocks. Doesn't mean it's going to ignite tomorrow. But we are in a new bull market. And history shows these things last for years, not months. This is another example showing how undervalued mining stocks are. The gold price is in gold, the mining stocks are in blue. You can see that they demonstrated a lot of leverage to the gold price before, but they've not caught up this time. So just to get back to where they were at their previous high, they're going to have to double, triple, quadruple. What happens in the meantime? My question is, what happens in the meantime if the gold price rises? What if it does go to 2,500? What if it does go to 3,000? Mining stocks are still going to be undervalued, even if they catch up to where they are there. There's going to be more M&A. I think this is one thing that could potentially spark some of the interest coming down in the junior sector is mergers and acquisitions. You've seen charts like this before, perhaps, but it shows that exploration and discoveries is very, very low, historically low. And I think this is going to potentially start in Q3, and here's why. After a full quarter of higher gold prices, the producers, all of them, are going to report higher cash flow, right? That'll be reported in Q3. They'll see that, and all of a sudden, they're going to have enough cash to finally come down and buy some of these smaller companies. I think that's probably going to happen this year. That new trend in M&A is probably going to start this year, and that's probably why. It is actually cheaper for a producing company right now, at this point in time, to buy the ounces rather than go out and spend money exploring and trying to develop the ounces. So if it's cheaper to buy and all of a sudden they have cash, we could see that starting by the end of the year. This is very interesting. This is the total global assets for that gold and gold stocks represent around the world. You can see what it was in 1921, then what it was in 1932, the 1940s, the 1980s, and then all of a sudden 2024 in yellow. There we are today. So there's a lot of potential for gold and gold stocks to represent a greater portion of financial assets going forward. I mean, it could double and it still wouldn't really even register based on what it's done in history. Real quick comment on copper. The copper price has been rising, right? It's great to see. The nominal price is rising. But relative to the S&P 500, the copper price is near all-time lows. So relative to what common stocks are doing, copper really hasn't moved all that much. So there's a lot of potential. And this is a ratio, so stocks can come down, and that would raise this ratio higher. But there's a lot of room for copper to grow based on this chart. And I think you've seen many charts like this, but there is a looming deficit coming in the copper industry. This is one projection. Supply is the red line. You can see what's going to happen. The various types of demand are the shaded areas. Let's say this analyst is off by 50%. Let's say he's horribly wrong. He's off by 50%. Those shaded areas are still significantly above what supply is going to be. So I think there's room for copper to really grow from this point, and I do want copper exposure despite the possibility of a recession. Okay, so what I want to do is show you some examples from history of what kind of gains might be out there that we could expect in mining stocks, okay? These are all in the book Pay Dirt. There's more in there as well, but I'm drawing from there for a lot of these. So this is the return of the junior stocks during the 1979 mania. That was probably the biggest mania in the gold price, was 1978 to 1980 January. These are some examples that we've actually went to the library and looked on microfiche. Who knows what microfiche is? Okay, thank you for admitting how old you are. So, but we actually looked at old newspapers to get some of these returns, and here's what we found. For all these tables, I'm going to just average them at the bottom. So in the bottom row, you can see what the average was. And you can see this is not just one or two. This is a whole bunch of them. And do you like what Copper Lake did? That's not a misprint. That's not a misprint. In less than 2 years, that's what the return on that stock was. But look at, let's say, what is that? North Air Mine. So if you were like, oh, it's North Air, big believer, yeah, you got a triple out of it. But it would have been much better if you bought a basket of these during this period. And that's one theme I really have, is you've got to buy a basket. What did the gold price do during 1981 to 1983? Remember, it peaked in 1980, right, in January, and it crashed, and it gave back almost all of its gains and went nowhere for years. And yet, look what some of these stocks did, and it was because of the discovery. And I think this could be something that could ignite our sector. The junior sector is a major discovery. Another Snowline Gold, another Hercules Silver. That's what happened here with these stocks. Right in that area where their discovery was made, there's the average gain of what they did. The mid-1990s, what did miners call the 1990s? The nuclear 90s, because gold and silver went nowhere. They couldn't make any money no matter what they did, right? And yet, there were stocks that outperformed in the middle of one of the worst bear markets in history, till recently. And yet, look what some of these stocks did. Again, I averaged at the bottom there. At the top two lines, you can see what gold and silver did. Gold was up 1%, silver was up 3%. Oh, and yet, look what some of these stocks did. And then we all know the bull market from 2001 to 2011. So what I did here was showed gold price and silver price during 2001 to 2008, and then the middle column is how much they sold off, and then the last column is how much they gained back from 2008 to 2011. So in almost every case, they gained back what they had lost during the big crash of '08. 2016, I had so many examples in the book that the publisher's like, Jeff, enough, But that's a great message. There's literally hundreds and thousands of examples of stocks that have hit pay dirt for all of us, potentially, regardless of what the metal price is doing. 2016, gold and silver price moved. Look at the big jump they had. Prior to 2016, a lot of mining investors were kind of depressed because nothing was really happening. Gold and silver weren't moving, the miners weren't moving, and all of a sudden this ignited. And there you can see the average of the producers in the middle column, the average for the juniors in that column. This all occurred in less than 1 year. Less than 1 year. There are many more examples in pay dirt. If you don't know, I actually interviewed 17 people for the book. So it's not just my method, it's input from a lot of people, all the way from the Rick Rolls of the world down to geologists you've never heard of, giving their insight in how to pick mining stocks, basically. But I asked every single one of them, give me an example, give me several examples of you personally hitting pay dirt. Look at this, Eric Fire, 5,000%, you see in green there. Ronnie Stoufferle, 1,900%. John Hathaway, 640%. Frank Holmes, 5-bagger. Frank Holmes, you can find 20-baggers, even 50-baggers in this industry. Ronnie Stoufferle again, 40-bagger on Osisko Mining. Mark O'Day, 3,000%. My favorite geologist you've never heard of, Ron Parrott, AUX, 725%. And my personal portfolio went up in 2020, 400% during the COVID bounce. The third theme I want to get across is, it's sort of how to play this, okay? And the main thing to be aware of is that we have to expect big corrections in the middle of a bull market. Somebody said yesterday, that's the sign of a bull market is you have healthy corrections, right? This is the number of corrections that occurred from 2001 to 2011. Look how many there were. There's like 1.5 every year, okay? And on the far right, I averaged them. So the average correction in that bull market was 12%. So gold hit almost 2,400, and we're down to 2,300 now. So that correction is 4%. So we could have a much bigger drawdown in the gold price and still be completely normal within the context of a bull market and what typically happens. You think, well, gold had a mania in 1979, 1978 to the beginning of 1980. But look how many big corrections there were in the middle of a mania, in the middle of the gold price going parabolic. Look at all the corrections that occurred during that relatively short period of time. And again, I averaged it there on the far right, what the average correction was in the middle of a parabolic rise for the gold price. The point being, you have to kind of expect that there's going to be corrections, and you've got to be able to ride them out. Okay, the most important slide of what I'm going to present today is what drives the biggest returns for mining stocks. So this Resources Policy did this big study, over 300 companies. They looked at the stocks, and they were just looking at the stocks. And they saw that most of them did what the industry did. They followed the industry. But they noticed a group of them outperformed what the industry did. So they wanted to find out, what did those stocks do, what did those companies do that helped those stocks outperform? So let's read this together. We parsed out the extent to which a mining firm's returns are driven by industry-level price fluctuations and hence largely out of management control versus by factors that may allow for more management influence. We found that industry effects drove the performance of average firms. However, company effects drove the performance of the firms that captured the biggest gains. In other words, they made a discovery or advanced a big deposit, but it's something management did. It's almost a cliche that we always say, oh, you got to start with the people, right? Everybody says that. This shows that it's actually more important than we may realize. You have to start with the strongest management, a management crew or team that can push a project forward in a meaningful, significant way, regardless of what the metal price may be doing. That's the outperformance that we're looking for. Okay, so let me go through some stocks of companies that I've talked to. I do not own any of these companies, but I talk to them, I like them, I think they're worth meeting with here. So let me run through some of these. How much time do I have left? Okay, so Arizona Metals, they presented here yesterday. This is probably a world-class VMS deposit. You can see some of the grades that they've had there. These are very significant grades of both gold and copper. 30,000 meters of drilling this year. Management, we have our whole net worth tied up in it. One of the themes that we really promote is I want to see management teams that have put their own money into the company. But I want more than that. I want them to be at risk. I want them to be financially at risk because then they're very motivated, right? That's what we have here with this company. There are many funds that cover this company. This particular one has a one-year target of 1050. The stock closed last week at 228. They talked about the potential spin-out. That's a whole other topic. I like this slide because it shows the capital structure there in the top right. That's not very many shares outstanding for what they have. They have a lot of analyst coverage. You can see there on the right. Bottom left, good trading volume. Bottom right, you can see that more than half of the shares are in very strong hands. Inflection Resources, these are in alphabetical order, by the way. This is a copper gold explorer in Australia. It's a 4-hour drive from Sydney. They said hardly anyone lives there. And if you look at their website, you can see there's nobody that lives here, right? So there's no NIMBY concerns at all. There are many majors in the area. They'll be drilling through the end of the year. They're going after big targets. Anglo is in an earn-in situation, but the threshold for them to actually earn in is very high. That was by design. So I like that situation that Anglo may like this big if it turns out to be a big deposit, but they're going to have to spend some money advancing it. Also a tight share structure there in the top left. You can see not a lot of shares outstanding. And the share ownership, you can see retail is only a third of it. Crescott Capital's in, many other institutional investors, high net worth. They do have analyst coverage. That's worth considering. Maritime Resources, they're here. Almost 4.5 grams per ton, proven and probable resource. This is not an indicated or inferred resource. In an open pit, 4.5 grams in an open pit. That's very, very good. So they will likely be in production by maybe year-end, maybe Q1. That depends on a number of things. But let's say, you can see their all-in sustaining is below 1,000. So they're going to have at least $1,000 margin on every ounce produced, probably more. Okay, but at $1,000 margin, that's $50 million in cash flow on 50,000 ounces a year. So that's very good. They already have a mill there. There's other revenue opportunities. They have exploration upside. They have a lot of shares outstanding. That's been the big bugaboo about this stock. Actually, I do own a tranche of this stock, so I should disclose that. But it's not a big position for me. But there's a lot of shares outstanding. That's been a big bugaboo. I think management has a plan to reduce that. Maybe even this year, we'll see, but you can talk to them about that if you want. One reason they have a lot of shares out is because Firefly Metals just bought 8.5% of Maritime. You can see why. You can see where their asset is, and you can see that Maritime's assets literally surround Firefly. So there's a very good relationship there, I think, that could help both companies, but especially Maritime. Outcrop Silver, 37 million ounce silver resource in Colombia. I'll talk about the step-outs in a minute, but this is a true primary silver project like Ian talked about yesterday. 3/4 of the resources in silver, very high grade, very high recoveries, 90% plus in recoveries. So there are silver mines in production today that have recovery rates in the 60 to 70% range. This has over 90%. This is a true primary silver deposit. And there you can see the grade. This is in their indicated category. You can see Santa Ana there for outcrop and the gold bar, higher than everybody except Las Chispas, which is already in production, of course. So very high grade. This is the slide that makes me interested in this company. In fact, I will probably be going to Santa Ana in Colombia in a few weeks, next month. So if I do, I'll be filing a report on our site. Anyway, the red lines represent the current resource, the veins of the current resource, okay, 37 million ounces. The orange lines are other veins that they're aware of that have yet to be drilled. So you can see there's a lot more orange veins than there are red veins. So the potential for this to grow is significant. They're drilling now. There's going to be results every 2 to 4 weeks. A lot of potential catalysts for the stock. So the stock is down like many. So it's a good time if you're interested. I don't own the stock yet, but I'm definitely looking at it. It may be in our letter. We'll see. But I do think this is probably going to be, probably a 100 million ounce resource. And if those grades continue, this is going to be a world-class deposit, and it probably will be a mine someday. Prismo Metals, I talked about this yesterday. 3 projects, but the main thing is Hot Breccia in Arizona. Infinitum Copper still holds 25% of it. That's where it came from. 5,000 meters of drilling is going to be done there this year. They do expect the permit any time. Prior drilling was showing grades of anywhere from 1% to 3%. That's very good for copper. They're doing lots of things this year. They have Palo Verdes, that Vizsla Silver owns 9.5% of the company and surrounds this little project of theirs. Pardon me, Los Pavitos is going to resume drilling soon. And management takes no salaries. They're not getting paid. So what I like about that is the only way this management team can get anything out of this company is if the stock does really well. And the only way the stock's going to do really well is if they make a discovery. So I like that. There's built-in motivation there. Okay, here's where Hot Breccia is. You can see it in the middle. But look at the title. Most copper mines come from porphyry deposits, and Hot Breccia is surrounded by 10 major copper mines, not in Arizona, in this little spot of Arizona. And you can see they're right in the middle of this. So this is a very good zip code. And again, they've already found anywhere from 1% to 3% copper. So very prospective, something to consider. Okay, so we have a lot of resources on the site. We're growing very fast. I started with the Gold Advisor, but I want to talk to you about that number 1 point there. So 2008 came, and I don't know, many of you were probably invested in mining stocks then, and you recall what happened to gold, silver, mining stocks, big crash, everything crashed, right? Well, we advised, I was with Doug Casey's firm at the time, and we advised as a firm that, hey, if you really want to speculate, now might be a time to buy mining stocks. This was in October, November of 2008, very bottom, it was ugly. Well, there were some investors that did do that, but I didn't. I was too scared to do it. Because remember, 2008 was a pretty scary time, right? Right in the middle of all this, and I didn't buy. But I saw what happened to mining stocks at the time, and I vowed to myself I would not miss another opportunity like that. And many years later, we had COVID. We had the COVID crash. And mining stocks are crashing, everything's crashing, right? And I saw what the gold-silver ratio did. It went to above 120 in, it's never been that high in history, ever before, in the 120 range, the gold-silver ratio. I started buying silver. I got silver at like 1305, I think was the spot price at the time when I bought. But I began to load up on mining stocks. In the middle of COVID, in the middle of the COVID crash, I loaded up big time. By September, my entire mining portfolio was up 5x. Not just a few stocks. My entire mining portfolio was up 5x. It ended the year up 4x. So you might say, I like big dips and I cannot lie. Because I bought a lot of that and it was very successful for me. So I vowed I would not let that happen. The Gold Advisor free coverage of sponsoring companies, we have 21 on there now, so we provide newsletter quality coverage for free. You just have to register and you can read all about them. Pater, there's the book on the left, How to Identify Winning Mining Stocks. There are some paperback copies here if you want. If you pay cash, you can get a discount for them. And we just started Pater Prospector. It's a paid newsletter. It's not expensive, relatively speaking. It focuses on, it doesn't talk, I'm not going to talk about the Fed. I'm not going to talk about the economy. I'm not going to talk about the COT report, manipulation, none of that. I'm only talking about mining stocks because Snowline Gold went 10x for us in the middle of one of the worst bear markets. Hercules Silver went 10x for us in one of the worst bear markets. I'm going to focus on what I think is going to be the next series of discoveries. And Joanna is going to tell me what that's going to be, and then I'm going to take credit for it. So just so you know. But Pater Prospector, that's what we do. We just talk about mining stocks. That's all we're going to do. So, my time is up. So lots of resources there, so I hope you visit it. So thank you, everyone.
From the audience. But maybe I'll start us off. And I'm going to challenge you on one. And I'm not 100% sure if I agree with that, what you said, is you should buy a basket of stocks over stock picking. It was one of your first slides. It's like, buy a basket of stocks.
Right.
So I'm challenging you on that. Like, where is that coming from and why? Like, especially in a still crappy market, why would you buy an underperforming GDX, GDXJ, or HUI, right, HUI, when maybe stock picking might be more successful? I'm just, challenging on that a little bit.
No, I do mean stock picking, but a basket of stock picking instead of just focusing on one or two.
So don't just buy the GDX and be happy, buy a basket.
If you want to follow what the industry does, get industry effects like that one slide showed, just buy GDX. But if you want the potential to outperform it, you've got a stock pick, but you still have to buy a basket of stock picking. So you wouldn't buy just one or two. You'd buy, if you're in juniors, you're going to have to buy 6, 8, 10 of them. So
okay, no, that makes sense. Okay, no, thanks for clarifying that, because it sounded a bit like you just go buy an ETF. And no. I'm definitely not a fan of that.
Well, you can, but I wouldn't.
Okay, no, perfect. Just like, do we have any questions from the audience? Let's start with second.
I saw the big gap between the gold price and the equity prices, and I assume you think the gap is going to narrow down. But I wonder if the low performance of the equity prices is not because of the low operational performance, because of the big G&A and that junior mining companies, if you take them as a whole, they lose money every year.
Right. I think that's fair to a large extent. That really underscores why you have to be, you have to focus on the very best companies that you think are going to be out there. It is true that the miners were irresponsible by the end of the 2011-2012 bull market. And that has largely been cleaned up now. So they've been a little bit better, arguably, than they were back then. And Kai might have a different opinion. But I think they've cleaned up some. I think it's still a matter of the generalist investor has not entered the sector. Why should I buy a crappy mining stock when Apple's soaring and I can get a new, a sexy AI stock? So I think that hasn't happened yet. We have record high prices in stocks. We have no recession. Why buy miners? I think when that changes, whatever that catalyst might be, that's when we're going to see some of that gap close. I think that particular chart, by the way, was referring to juniors, not the miners as a whole. So it was referring to the venture index. So I think that gap closes once we get whatever the catalyst might be, whether it's a discovery, some big M&A thing people weren't expecting, who knows. So.
We had another question over there.
Yes, you introduced some company Outcrop Silver on your presentation.
Yeah.
But I think since 2007 it's dropped 99%.
99%?
Yeah. Well,
okay.
Correct. So I don't know. So if we check the stocks, if I lost.
I'd like to see if that's actually true, but.
A lot of companies have a lot of legacy and a lot of issues like rollbacks and things like that. So, and I have to say,
99% of my capital, and I recover 5x from this $1 from $1,000. So it's like a little bit, yeah.
Well, a lot of stocks are in that position. I don't know that they've lost 99%, but a lot of stocks are in that position. So I think.
No, it's like you're absolutely right. So maybe I can jump in real quick, Jeff, as well.
Please.
Like I'm just looking at the chart here, just on CO.ca, one of our media partners, by the way. Yeah. It's like, so the thing is with these companies, often they become a shell. They have a project before, it doesn't work out, so they go belly up. Maybe they don't go completely bankrupt because they always find somebody who gives them $100,000 to pay the TSX and their accountants. So they stay alive. Then a new project, a new management team comes in. The stock maybe runs again, people invest, they lose money. Sometimes they forget that they actually own the stock. And then you have a chart like this. And you don't really see it, I don't have a camera here, but it is just peak, and then it's just flat, pretty much flatlining around zero the whole time, right? And then a new management team comes in, a new project, so the long-term chart absolutely looks disastrous, but it's a completely new team. So it's a bit of an unfair comparison. Personally, I would look at when the new management team came in, when did they refocus on a new project, and that's where I would draw the line. But it's a valid point. Those companies and those charts exist. I hope that helps.
When I look at that, I go, wow, that might be a good buying opportunity. So
it might not be. Who knows? So good question.
We'll find out. Like I said, I'll be there next month. So
oh, fantastic.
I'll file a report.
You talked about the very profitable effect of buying on extreme depths. And I just wondered if there's anything to be said for being 100% invested in cash on the expectation that an extreme dip might happen once every 10 years and you can buy them?
I didn't quite.
So you mentioned that you love buying on extreme dips, like the COVID dip.
Oh, right.
And I think his question, I hope I'm getting it right, is like he said, if you were to sit on 100% cash right now, when is the right time to buy? Is that the questions? Or?
It's basically, it's as an investment strategy.
Or do you expect another dip maybe?
There's
Strategy, is it worth being 100% cash?
There's never a right time to buy, and there's always a right time to buy. And then there's a whole gamut in between it. So how I personally handle it is this. I have a lot of exposure to mining stocks right now, and I've had it for a while, despite all the indications that we were going to have a recession. The stock market was overvalued and it was going to crash. I still wanted exposure to mining stocks. My hedge to that is having a lot of cash, okay? And sometimes I violate my own policy. My cash dips down a little too low, but that's my buffer. If we do get some kind of a crash that pushes mining stocks back down, again, remember, they've already crashed quite a lot. So I agree with Kai. I think we are at the bottom. But let's say we're not. Let's say we're wrong and they crash again. I've got a big cash buffer that I can either just write it out, or I can average down or buy some new ones, or whatever the case might be. So I think you always have to have cash. And if you really do fear a recession or a crash or whatever, then that tells you your cash level needs to be higher. So
does that answer the question? Yeah. Okay. Simon, you raised your hand as well.
Yeah, this is kind of a follow-on question. So buying the dip is always a fun experience, and that old saying, buy when there's blood on the streets, or buy when the cannons are singing. And so looking for these dips, is the next dip, could it be possible for the junior gold mining stocks at this time it's different, that all the weak sellers are already just not there,
That's a great point. Yeah, they may be gone, because remember what happened last year? It was a terrible market for years, especially with the juniors, and all of a sudden they crashed by 50% again last year. So it's hard to imagine some of these going that much lower. Could they? Sure. It depends on what plays out. But I see opportunities, and I'm taking advantage of what I see as opportunities, while still holding that cash level to where I have a hedge or a buffer if things do go south.
Another question over here.
I think you wrote also in your book that it's not only important when to buy, but also when to sell. So do you have something like a selling target in advance when you buy a stock, and you have certain expectations?
Yeah. Yeah, it depends on the reason you bought that stock. What is the reason you bought that stock? If it's a junior, it's probably some type of discovery, expansion of a major resource, right? So, 3 strikes, you're out. If you drill 3 different times, and there's no discovery, generally speaking, I'm looking, okay, am I going to stick around in this stock? The answer may not automatically be no, but if you've struck out, the reason for my investment has not panned out, and I may need to look elsewhere. So start with the reason that you bought the stock. That's how I play it. But I can tell you exactly when gold will peak. I can tell you the exact moment. So my brother, do I have time for a quick story?
Yeah, we got 3 minutes. Yeah, go ahead.
My brother was a stand-up comedian, and he worked in Hollywood, and he was in a couple movies, and he was in the show Friends. Remember the TV show Friends? So he met the whole cast and crew, and he just fell in love with Jennifer Aniston. He said she is more beautiful than she is more beautiful in person than she is actually what you see in TV and movies. He said it's the most beautiful woman in the world to him. So you have that image, okay? And then, if you look at this, you see a guy that's balding and a little overweight and, scares little children on the beach because he's so white he can't tan. He's getting older. He's not very attractive. So when somebody that looks like Jennifer Aniston calls somebody that looks like me to ask about, Jeff, what mining stock should I buy? That, ladies and gentlemen, will be the top in the market right there.
You're going to post on Twitter about that phone call, aren't you?
Yes, and so, if you want to the top, just ask me, is Jennifer Aniston calling? If I say no, you're good to go, But if she's called, then, get out. So
that's a good anecdote. You have any more questions? Because I have one more for you as well.
Yeah.
All right, I'm going to ask it. Like the GDXJ and the HUI, for example, or GDX, and the composition has changed over years. So how valid is it still using it moving forward?
Yeah, that's a great...
we're simplifying, obviously, but it's how valid is that still as an indicator, because the composition is constantly changing.
Yeah. The GDXJ has producers in it, some big companies in it. So how valid is it? Are those really juniors? I think Pan American Silver was in there at one point. So I don't...
Kinross, I think.
Yeah, Kinross was in the GDXJ. It's like the 5th largest gold producer in the world. So, I don't put a lot of stock or value into how they may manage those funds. The thing about those ETFs is, you can follow the industry, but you're going to get the bad with the good. So that's why I don't do it.
No, fantastic. One last question then.
You are very experienced, and you are in this mining branch since many decades. So what would you think is the environment of financing or to raise capital for developers and juniors compared with other decades?
Compared with what?
Compared with other decades or other decades in the...
Other sectors, you mean? Or other?
No, it's like in this sector. It's like you've obviously been in this sector for a while. Like, how does that compare to the past? Anything you've seen in the past through your experience?
Oh, okay.
How good is it? How bad is it?
Because you said
it's
very difficult to raise
it is.
New money.
Yeah. So when you see a company that can raise 30 million or 10 million for a tiny company, that's a pretty good sign in this environment. The flip side of that is if their stock's depressed, the dilution is very high. But obviously it depends on what you get for that dilution. So I would say it's bad. I wasn't investing in the 90s, so I can't compare it to then. But it's not good. But there are, it makes it a little easier to pick some gems out of there. Look for the companies that are able to raise a lot of funds and push their projects forward. Company effects. Are they going to have the cash and the catalyst, the 2 C's, to push their project forward? If they have that, you might have a good investment there. So,
awesome, Jeff.
Okay,
that was wonderful.
great.
Everybody else, thank you so much for your questions. I hope that was insightful. And this will be uploaded, of course, to our YouTube channel as well.
Okay,
Jeff, thank you so much.
Thank you.
And